and we have been able to get a good idea about the rating model and use. We just discussed about the rating model in two different aspects. One is the obliger risk rating. The other one is the facility rating. When you talk in terms of obliger rating, you look at that obliger risk profile, take into consideration some factors, basic factors, business and market, financial, management, and that type of will take into consideration. And for each aspect, there are parameters, 4 or 5 parameters, and all these parameters are given a weight. Each of these parameters is given a weight, and as per the weight, the scoring is done. For each parameter, there's a scale of 5, starting with 1 and ending with 5. 1 refers to a weak position, and 5 refers to a very excellent position. In between, you can have different numbers from 2 to 4. So that is how the scoring is done. So with that scoring, we get the total scoring for obliger, and then the obliger rating is determined by applying the number of marks received by the obliger. And the other side is the facility. The facility also has 3, 4, 4 criteria where we do the scoring. And there are also a score is given, and that score, according to the score, can be mapped into a certain grading. So then, for each counterparty, you get the obliger rating and the facility rating as well. Then, if you want to get a consolidated view of those things, you need to get an idea about the expected loss basis. So on the expected loss basis, because the facility rating gives an idea about the loss given default or recovery. At the same time, the obliger rating gives an idea about the probability of default. So then the probability of default is signified by the rating of the obliger, and loss given default is also signified by the rating given in the facility. If you get the multiplication, you get a notation about expected loss. So in that criteria, you can consolidate the both ratings. That is how that both ratings be consolidated. I think we have done it as an exercise. We have gone through a certain case, and we call that counterparty as NCD, National Communication Devices, and that organization is the borrower with a certain bank, that is, we call it SIFI Commercial Bank, and that is the case we studied. And today what we are trying to do is we will see how we can apply this rating model into a different sector, because that particular counterparty was we took that counterparty from manufacturing sector, but there can be several other counterparties who would be in either service sector, commercial real estate or consumer type of a sector, trading sector. So likewise, you might have different sectors represented in your credit portfolio. So then you need to have different rating models for each of these sectors. Otherwise, you would not get the valid results. In order to get the valid results, you need to classify your borrowers, your counterparties into different sectors. Because the sectors will have different characteristics. And those characteristics we have to select the most critical characteristics which represents the creditworthiness of the counterparty. That is in one side, the other side the facility. Okay, so we can now turn into those things. Can you see the text on the screen? Can you see the text on the screen?
Yes, sir.
Right, okay. So then we will just go through it and just get the things again. And as it is, one dimensional risk rating matrix you can just see. Now, if you go into the risk ratings from 1 to 10, those things being represented as negligible risk as AAA and the 1 year expected default frequency or the PD, probability of default is 0.01%. That is a AAA type of rating. Then if you go into the grade 2, that is also very low risk, but there the 1 year EDF comes to 0.05 and approximate external rating is AA. And number 3 is low, the risk level is low, and 1 year EDF comes to 0.10. Now you need to just alternatively say that 1 year EDF is very approximate to the probability of default. So therefore, even if you call it probability of default, that doesn't matter. Say then it is 0.10 and that is coming to the external rating, or that is mapped to the external rating A. And if you go to moderate level, that is number 4 in our risk rating scale, there the EDF would be 0.5%, and that comes to triple B. If you go to next one, that is average risk, it is 1.25%. That is double B. And when you go to marginal risk, it is 5.5. It is B. So what you can see is when the grading goes beyond B, the 1 year EDF exponentially increased. When it goes above B, above in the sense that is adverse rating than B, just the next rating would have a exponential probability of default. Now you had only 5.5 in B, whereas you get 25 in triple C, and it is doubled in the next level, that is substandard, that is number 8, 50. So you see the cutoff point. The cutoff point is the last grading in the performing advances. It is 5.5. So the meaning here is you can have a threshold detector. So what is that? If a probability of default goes beyond 5.5%, then we can say it would be a non-performing type of a loan. So that can be taken as a criteria. So even if you just try to see the credit grading or risk grading of a counterparty, if you find that counterparty beyond 6, so you can have a principle not to entertain such type of counterparties in your organization. So that is a type of a basic principle. So anyway, so these things I am just giving you how you can practically use this risk grading matrix. Then you can go to the risk rating scorecard process where we have comprehensively discussed last time. Right. Now I can just go through it again. The obliger rating, the first aspect is the business and market aspect. There you have parameters coming under that. Market conditions is one parameter. Product diversification is another parameter. Company competitive position is another parameter. And years in business is another parameter. So those parameters are given different weights. The market conditions given a weight of 15%. Product diversification given a weight of 25%. Company competitive position given 20%. Years in business given a 40% weightage. That's what I stressed about it. And the years in business is taken as a critical factor in business and market conditions. Because I think it is fair enough, because a company's strength or company's long-term stability can be connected or related to the number of years in business. If a company is in the business for a longer period, that signifies the stability of the business. So therefore, giving a higher weight for the years in business could be justifiable. I don't know if you have any other ideas, you can come up. Now, my intention is to give you a guideline, and you are free to take your own decisions within that guideline. So in other words, if you feel that these weightages are not relevant to your conditions or not compatible with your conditions, you are free to think and decide on your own with regard to the weightages. In other words, if you feel that these parameters are not really compatible or not really worthwhile or not really meaningful, so there also you have your own freedom to select whatever the parameters you think as suitable. You get my point? So then this is an exercise where you have to take control. And you can really add more value to this rating model with your innovative thinking. Okay. So that means if you think that these parameters are not not relative or whatever it is, not suitable, so what you would be in a position to select your own parameters. I really appreciate that type of innovative thinking. Okay. So then you go to management. There are also, you have different parameters, the quality of management, company external credit rating, quality of operations. I can remember one person suggested to just give here another parameter, which is the CRIB status or whatever. So I think that's a good suggestion, because in Sri Lanka, most of the counterparties would not have a external credit rating. So that you are free to do that. CRIB status or whatever can be taken here. Then the quality of operations, quality of financial reporting and audit. Now all these things can be taken under management. So if you think that these parameters are not enough or not adequate, you can introduce some other parameters also. That is one way. The other way is, if you feel these parameters are not relevant, then you can just take out those parameters and introduce on your own another parameters. So that is how you can deal with this. No, but what I need is to give you a certain skill to develop a risk rating model, and it would be very much beneficial for your organizations. Through that, you would be in a position to enhance the quality of your loan portfolio. And when your loan portfolio's quality enhanced, and that will affect your organization. And in that way, there are many organizations, many financial organizations, many banks. So if you can do that in all these banks, the overall country's portfolios, the quality of portfolios will be enhanced. So that is my intention, to give this knowledge to you, and it can be taken as a skill. Now that skill can be developed on your own. If you are really with your due diligence or whatever, you will be in a position to develop that skill. So my advice is for you to just look at these things again and see whether you can ask these questions from yourself. First thing is whether these weights are okay. So if you feel that these weights are not relevant for your conditions, what you can do is you can change those weights, provided that the total comes to 1. That is one side. The other side is, if you feel these parameters are not adequate, so you can add more parameters. So that is the second question. The third question would be, if you feel these parameters are not relevant for your conditions, then you can remove those parameters and add your own parameter. Now, there are three questions you should ask. First of all, you need to see whether these parameters are okay, or whether they are given adequate, or number of the weights are okay. If these weights are not okay, you have to just change that. And if you feel that these parameters are not adequate, so you can add more parameters. And the other thing is, if you feel these parameters are not relevant for your conditions, you can remove the parameters which you think is not necessary. You can add new parameters which you think relevant to this. You get my point? So this is how you can apply the things to your conditions, and what we call it customization. Customization, right? Then the other thing I want to just explain is, when you go into financials, you have taken, now here it is, there are financials given here: current ratio, quick ratio, inventory turnover ratio, gross profit margin to assets, expense ratio, return on assets, debt equity, cash flow coverage ratio, sales growth rate, net worth to asset ratio, and all that. And all these ratios are given the equal weights. And you have taken, now here they have taken 10 ratios under financials. So then you need to understand the meaning of all these ratios. So that is also given here. In order to give you a better understanding, I have taken another text to explain you regarding these financials. So that also I will take into consideration at a later stage. So in this text also, these ratios are being explained. Now these are the balance sheet. This is the balance sheet, and those balance sheets were given for 1, 2, 3, 4, 5 years. And income statement is also given, and the definitions are given for all these ratios. Then the ratios are also given for all 5 years, and the averages taken. And those averages are compared with 5-year peer average. Peer in the sense, the same type of companies, they go through the peer company financial statements and then got their ratios, the similar ratios, and they had the study to get peer average. And the comparison is made. So in order to give a scoring for this, so these peer averages are very much important. So if you see now, when you do the NCD ratio analysis, you can just look at the current ratio, and their 5-year average is 2.21, whereas the 5-year peer average is 2.5. So that means now they are in a strong position in current ratio. So we'll see what is the score they have given for that. Yes, they have given 4. 5 is the best, but it is little one below the best. So therefore they got 40 marks for that. Now see the point. So this is the methodology you have to convey to the people who use this rating model. Because in an organization, one person cannot do this. You have to just convey, deliver lectures or whatever, and just convey the methodology to all the people who use this rating model. Then you have to explain how you can do the scoring. In order to have a validity for the scoring, there should be another independent party who need to go through the scoring and see whether the scoring was done in a proper manner. That is what you need to do. Now I can just get another example here also. Say, right, return on assets. Now return on assets, their average is only 0.015 return on assets, right? So we will check the peer return on assets. You can see the peer return on assets is 0.15. Now 0.15 is in percentage form, it is 15%. Whereas this organization has only 1.5%. You can see it is 0.15. 0.15 is 1.5 as a percentage. So then what is the scoring they have given? What is the score they have given? They have given 1 only. Just look at it. Here. Yes, they gave 1. Even debt equity also the same, 1.13. So 1.13 is a high gearing. So therefore, there also it is only 1. Cash flow coverage also, they don't have that much of a cash flow coverage. So that is why it's only 0.524. So therefore, it is only given 2. So likewise, you can see how these and the criteria. Now, if you want to just give an awareness to your team about this scoring system, what you need to do is you need to just take an example and show them how the scoring can be made. Now, I think it is clear. Of course, the scoring onto the financial ratios would be very much important for a credit grading scorecard. So therefore, you have to be very careful about these things. And you need to tell them how you can allocate marks. As I told you earlier, the criteria here is to see the obligors ratio, that is the average, and that average ratio is compared with the peer average. So in that comparison, you can decide a score for that. Now, for example, as I told you, their current ratio is, the average current ratio is 2.208. Whereas the peer ratio is 2. It is very close. Therefore, they got 4 marks. That is at a higher scale. 4 is a higher scale. If the score is more than 3, it's a very positive position. Even the quick ratio also, 1.195 is their ratio, and you can just compare it with the peer ratio. And if they are very much close to the peer ratio, higher than the peer ratio, they get high marks. If it is little below the higher ratio, the peer ratio, they might get 4 marks also. So likewise, you can just give an awareness to your team members regarding the methodology for marking or giving scores. I think this explanation is adequate for you to understand that. And the other one, Now, this is a very important thing to consider. Cash flow at risk. Now, if it is within the cash flow tolerance, you might get a high score. But here they have just assigned only 3. So we have to see why this particular organization is assigned with 3. Now you can see the cash flow coverage ratio, whatever, cash flow at risk, that is being decided to this financial analysis, the debt equity ratio, cash flow coverage. These are the ratios where you can consider when you just give a score for that. Right now, I think it is explained here. In figure 7.2, deterioration in cash flows below CFI would likely force the company into some level of severe financial distress. Understanding the drivers of that stress would be important to the analyst as it could provide insight into what aspects of the company's financial picture may pose risk sometime in the future. The cash flow simulation for NCD established that its cash flows would remain within the CFAR threshold, and as a result, it was assigned a score of 3. Now, just look at it. Now, this is what the cash flow at risk. This is the normal cash flow. Now, if it is becoming below normal, that is the amount, that is the particular margin the cash flow is at risk. Yeah, the consideration was here. Although different standards of performance may apply, a cash flow coverage ratio below 1.2 signals potential problems by the firm to satisfactorily service its debt from operating cash flows. Only in the past 2 years has NCD been able to generate cash flows that support its debt service by a factor of at least 1. Now, even though the cash flow at risk or whatever, or cash flow coverage ratio is taken here as a criteria in scoring. Now that in the scorecard you can see that cash flow at risk here. So this is now I think in my opinion this is the most important factor taken into consideration, because this is a critical factor in relation to the repayment capacity. This is the most critical factor in relation to the repayment capacity. Why? Because if you do not have a cash flow, you would not be in a position to pay back your commitments, pay back your obligations. So that is why we need to give a high importance to this. That is why it is assigned 250 marks. But this organization got only 150 marks out of 250. It is little higher than the 50%. 50% we have 125, but they got 150 because if 250 is 1, then 100. Sorry. Now 3 is because the highest marks should be 5. No, 5 represents 250, 3 represents 150. That is how it goes. So I think you need to give more attention to this, since this is the most critical factor which decides the prepayment. Now, when you say the cash flow, so that is the most critical in this risk grading scorecard, and you need to have a thorough understanding about the cash flow of the company. So I think I have seen in several companies, they don't have that much of consideration about their cash flows. They just rely on the profit and loss account, because those things are prepared on accrual basis. So then that would not give a realistic view of the cash flows. Therefore, you have to do a cash flow analysis of all these obligors. If you don't do that, you will not be in a position to get an idea about the cash flow at risk. And you are not in a position to see whether they are within the cash flow at risk tolerance. So that, of course, you can just see how you can decide, how you can identify whether this organization is within the cash flow at risk tolerance. So that you have to just get a good idea about it and see, and you need to assure that your obligors cash flow analysis is perfect. If that is not the case, then that could be, you would not get a valid result here, and therefore the valid marks would not be there. Right. I think with all that, we have been able to give rating for this organization. And today what I want to do is, I want to just tell you for another type of a sector, or for another type of a counterparty, how we are going to do the scoring. Right. Now in the review process, these things are given. We have, last time also we went through this. If the score is more than 1350, it is in 1, grade 1. That is just like AAA. Then 1150 to 1349, it is 2. So likewise, you can make the credit grading. You can grant the credit grading by looking at the score, the obliger. Facility also, you have a rating scale. Now in the loan review, what we need to do is, we need to now say, now this is actually after 1 year. After 1 year. So I have not gone through this last time. Now we will see the same organization being given a rating after 1 year. So then after 1 year also you need to do a scoring. You need to apply the scoring to the organization and see whether there's any change. It can be a change to the better or change to the worse. So we can say whether it's an adverse change or favorable change. We will check what has happened to this particular organization in CD. So after 1 year, the loan review team has done scoring again. When they did that scoring, for the obliger ratings, they got 250. 250. So we can compare it with the earlier one. Now just see. Right. In the business and market aspects, there's no change in the overall position, because last time also it is 250. Now we can just look at the next one, that is management quality or whatever, management position. There they got 275 marks, but we can see whether after 1 year also they got the same or whether it is higher or lower. Now you see. Now they got only 215 as against 275 last time. Right. Now we can see in which parameter they got lower marks. We can check that. You can check that, of course. Now, if you just do a comparison, right. Good experience and strategy focus, company external rate rating, good controls and process. Now here three, but I think in the next year, I think they have some deteriorations in some areas. Good controls and process. Now they got only 2 marks here, and sound practices also they got only 2 marks. I think because of that. Sorry, they had 4 marks. I think last uh, time also. They just had a uh, adverse level next time. So you can see as against 275, they got only 215 here. If you go to financials also, you see some difference. Earlier it is about 700 something. Now they got only 685 here. Hmm. 765. That was the last score for financials. This time they scored only 685. It's a substantial reduction, deterioration. So it really uh, denotes a real deterioration in 1 year. Right. Now there here also you can see a deterioration. Last time they got 150. So then their total marks would come to 785. And the facility rating also, last time they got more than this. That is also that also came down to 175. Now, what is the issue now? So we can say the particular obliger being migrated to an adverse rating grade. Adverse rating grade. So it's like this. We will now see what is the exact rating for them in the second year, next year also. Now, as per the new, as per the earlier one, there also they got 175. Okay, there's no change in the facility rating, I think. Right. The second year, the obliger score is 685 plus 100. That is 785. And the facility rating remains the same. That is 175. Right. Now we can just see, as per the rating scale, what is the rating scale they get? Now just look at it. Now just look at it and see what is the rating grade they get for the first year. Yes. Obliger rating. What is the rating grade they get for the first year? Yes. It's simple, huh? And just tell me, they have obliger score 915 and facility score 175. So in that case, what is their obliger and facility rating grades? Yes. Yes, now Sumudhi has asked a question also. Anyway, now before answering that question, can you just see the grading of this obliger for the first year and the second year? Anyway, you just give the grading for the first year, obliger rating and the facility rating for the first year. Yes. This is simple. Yes. You should come up with your gradings. What is the grading, obliger grading for the first year for this counterparty?
Low, because it's
Yeah.
125, rating is low.
And
The rating should be low.
yeah, of course. But anyway, now what I need you to do is you just look at the rating scale and give me the rating for this obliger in the first year and the second year, and also the facility rating for the first year and the second year. But there's no change in the facility rating, but obliger rating is changed. So what you can do is you can just look at the rating scale and see what is the rating they can get. That is a simple thing. So I will just do it. Right. Now just look at it. Since they have got only 915 in the first year, so they are in the moderate grade. They are in the moderate, that is 4. Their rating is 4. Their rating is 4 for the obliger rating, that is 4. And then in the second year, their rating will be, it is 9, sorry, it's 785. So it comes to the next grade, that is 5. Rating is migrated from 4 to 5, obliger rating. There is no change in the facility rating. Facility rating is, say, since the score is 175, the facility rating is is 7. Yeah, facility rating is 7 for both years. Right. I think last time also we just went through this, but we have not just discussed how we can consolidate these two things. Now, in the consolidation process, what we have to do is we have to see the mapping. Now, the mapping for obliger score is done through the EDF. Through the EDF. But mapping for facility rating was done through the loss given default. So I can show you that scorecard. Right. Now you can see now as it is now our ratings, the ratings which we did map to these external ratings also. Now when you say negligible risk, that is the first grade 1. Grade 1 is mapped to AAA. Now therefore the grade 4 is mapped to what? Triple B. Grade 4 is mapped to triple B. But what happened next time? It was migrated to double B. It was migrated to double B. So that's what happened for this counterparty. Right, there was a question asked by someone. I will answer that. He asked how the EDF is decided. Is that generated from rating transition metrics based on historical data? Yeah. Right. I think there are two things in this question. I mean, in this answer also. When the EDF is decided, say, it's a type of a decision which could be based on historical data in one side. So that is how we can do that. So what we should do is, say we have about 1,000 loans, say 1,000 loans, or even 100, say 100. We have 100 loans sample. what we do is we do a rating rating scoring for that, and we just arrive at the obligor rating for those loans. And we do it annually. We do it annually. Now, when you do it annually, what we have to do is we just see on a particular, on a certain end year exercise, you did the scoring. Next year also you do the same scoring. Then invariably there can be changes. Now, those changes could be either to the adverse or favorable. If the score comes down, then it would be a adverse movement. If the score goes up, that would be a favorable movement. Right? Now, if it is a adverse movement, there also you can just put it. Then the second year rating profile also you can arrive at. Third year also you can do that. So likewise, you can prepare every matrix. You have to prepare a matrix for that, and that matrix can be prepared for each year. Now the question of deciding the EDF. So that question is also answered through that. So we will see how we can do that. If you just take 2 years, and here also we did it for 2 years now. First year we had the score 915. We had the score 915 for the first year. Second year we had the score 785. And it's an adverse migration. Adverse migration. So this is only, now we have taken only one obliger, no? But whereas we can do these things for all the obligers in the bank and do the scoring. Now if you do it for 1 year, you can get their ratings for that year. And we take the same set second year and do the scoring again. Then we will see that we would see that some of the obligers will have a lower score. Then those obligers been migrated to an adverse position. Some of the obligers you would find with higher scores. They would migrate to the favorable grading. So that is what happens. So this can be represented in a matrix. This can be represented in a matrix. So we call that matrix the rating migration matrix. Rating migration matrix. Now in that matrix, you will find not only the facilities or the obligers gone into the adverse grading, some of these obligers will migrate to the default. What do you mean by default? The gradings lower than 6. The gradings lower than 6 would be that. So that is how the exercise can be done. Through that, for each grading, you would get few loans in the default category or non-performing category. The EDF could be arrived at that way. For your Sumudu's question, one answer is that. That is one of the answers. The other answer is, now as I told you, when the scoring is done, we can have a mapping for external rating. Now in this particular case, when it is 915, it is mapped to triple B. Triple B. So for external rating agencies, they prepare rating migration matrices. And they prepare these rating migration matrices for different sectors also. Who prepare the external rating agencies, either Fitch, S&P or Moody's. They have their own rating migration matrices for a particular country, and there are different sectors. And that is an overall thing. So then what we can do is, we can get the score and map into an external rating. Now in this particular case, our case, it is mapped to triple B. Mapped to triple B. So these external rating agencies, as I told you, they publish rating migration matrices. If you go to that migration matrix, you would see under the triple B, what is the default rate? That default rate is taken as the EDF for our advance. That is how the EDF is arrived at. So as I told you, there are two ways. One way is you can go through the historical data for your ratings in your organization. Those are all are internal data. Through internal data, you would be in a position to get the EDF calculated, or otherwise you can map the score to a external grading, and you can get the external grading migration metrics from external grading agency and just compare the particular grading's probability of default. So that is taken as EDF. Is that clear? Is that clear? You know what is a rating migration matrix, no? I will show that on the board. Right. Now, this is the obliger rating. So what I can do is external grading also we can put. When it is 915, the external grading would be triple B, double B. And internal grading, 4, 5. I think this is clear. Now this is the situation with regard to our counterpart, that is NCD. Their score, Obliger score is 915 in the first year. The score of they got the score of 785 in the second year. The facility grading or facility score is only 175 in the first year. Second year also the same. There is no change in the facility grading. But you can see, if you get the external grading, map into this. You can get it as triple B. And in the second year it is double B. It is migrated to an adverse grading. If you take the internal grading, it is 4 for the first year. In the second year, it went down to 5. Right. Now we will see the connection it has with EDF. Now for triple B, there is a particular EDF as per the rating migration matrices published by external rating agencies, either Fitch, Standard & Poor or Moody's. We need to get that type of a migration matrix and get the probability of default or EDF for triple Bs. And that EDF can be applied here. That is one way of doing that. So EDF can be found with the rating migration matrices published by external rating agencies. Then you can go to that type of migration matrix and get the triple B's EDF. We can consider that as the EDF of this loan. Now, in the second year also, since it has been migrated to the double B category, so you can get that year's rating migration matrix from an external rating agency. There you can see the EDF of double B grading advances. So then the EDF of this advance also being taken as EDF of that rating migration matrix. That is one way. But I think that may not give you a realistic result. What is the reason? Because when these rating migration matrices prepared, they went through a different set of loans. Who mean they are this external rating agencies. They got a separate type of a set of advances. But the most valid EDF could be arrived at through the historical data in your organization. So there also you need to do that exercise. What is that exercise? Every year you need to do scoring for your advance. And you have to have a migration matrix prepared. With the preparation of that migration matrix, that is for yourself, for your organization. So we call it internal rating mechanism. From that also you can have a migration matrix prepared. And through that migration matrix, you can get the probability of default of a certain grading. So you have gradings up to 10, no? 1, 2, 3, 4, 5, 6, but up to 6 only we do it. Because so you can then just prepare it and see in the first year how many loans are in category 1, how many loans are in category 2, likewise. Then you do the second year's scoring and see out of this 1 year grade 1 category, how many loans migrated to grade 2, how many loans migrated to grade 3, how many loans migrated to grade 4. Likewise, you can prepare another matrix. So that is what you call the migration matrix. In that migration matrix also, you can have a number of loans. You can just determine how many loans migrated to the default from double B category, triple B category, or so and so forth. So that is the EDF of that particular category. So that is how the EDF can be arrived at through historical data. So then you don't need to go for external rating agencies' migration matrices. You have your own migration matrices in the organization. I think that question is answered. Is that okay? Is that answer okay? Sumudu?
Yes, sir. It's
Right.
clear.
Right. Now we will again go to the lesson. Right, now you can just look at the EDFs taken from rating migration matrix anyway. Right, now we need to go to the lesson again. The second year, now after 1 year, they did the scoring, and with that scoring, I just gave you the result. Then we need to go for another type of advances called CRE, that is commercial real estate. So they have taken different parameters in addition to the parameters taken in earlier scoring model. Now these are the key CRE risk attributes. I think I just discussed this last time also. Absorption rate, property sale price, contingency reserves, rental rate, vacancy rate, interest rates, loan to value ratio, debt service coverage ratio. Now these are the main attributes of a CRE scorecard. So that is how you can do a rating model for CRE loans also. Appropriately, you can put these things into different aspects. I think these things can be taken into market aspects or financial aspects. This property sale price, absorption rate, or whatever can be taken into market even sometimes. Interest rates, vacancy rate, and all that is also. Interest rate, loan to value ratio can be taken into financial. Debt service coverage ratio, that can be put into the financial aspects. So likewise, you can just, I think if you have a good idea about these each attribute. So what do you mean by absorption rate? That is the metric describes the rate at which properties or units with similar features are absorbed by the market over some time interval. So that is, I think that is understood, no? Vacancy rate is now if you have a building and how many of the things are occupied, or that is what you call vacancy rate. So likewise, now these things to be developed. Can you see these things on the screen? Can you see the things on the screen?
Yes, sir.
Right, right. Now I decided to have this text also with regard to the financial risk here. So when you just go through that, I am not going to read everything here, but I want to just stress on certain aspects in this text. Now you can see through financial statements or whatever, in a business context, how can we gather information through the financial statements? So this is the most simple form of corporate activity. But if you go to the next level, uh, business and corporate activities also can be gathered through the financial statements by going through the decisions and actions, choice of account for policies and all that. Then you have standard accounting practices. They are also, those accounting practices also can be taken into consideration, or you can get an idea about that through the financial statements. Then the industry factors, suppliers and customers, technology, business cycles and all that. Then the external environment. So through the financial statements, you are in a position to have some idea about these things. But it is a limited scope, but in order to get all the external environmental factors into consideration, you need to do a thorough study. So that is why the quality and quantity of financial statements are important. The quality of financial statement, because that all depends on the organization's management quality. That is why the management's responsibility for the financial statement is given here. So of course now in a credit evaluation, this is a main factor in the evaluation process. Because if the management is not really concerned about the processing of their financial statements, then of course they don't have a responsibility towards them. And that shows the real negligence of management towards that. So that is a very bad or negative factor for the organization. Then there's another responsibility coming from the auditors. Then the quantity means the types of financial statements they have. Not only the balance sheet and profit and loss, then you need to have the cash flow statements, the statement of change in equity, and all those things should be there. And you should have the historical data also in order to have an idea about the organization. Now, my intention of giving this text for you is to give you a sound idea about the financial analysis, a sound idea. Because the financial analysis is very important, or it's a type of a quantitative analysis among the qualitative analysis, because it is more objective. That is why we put our attention to these things. And this should be, you should read these things. I'm not going to read for these things, but you need to read these things. And the next main idea I want to convey is the cash flow statements. Because in a rating scoring system, you need to give a prominent importance for cash flow statements. And as it is, if you get a cash flow statement into the rating scorecard and just construct it on the scorecard and have an automatic scoring for that, that would really automate the process, and it would simplify the process, and you can get a valid score for the cash flow generations and the type of cash flows or cash inflows and outflows. So they can just take those things into consideration and give an automatic score for that. Now these things actually we are not in a position to discuss, and you need to go through that, because in order to give you a sound understanding about these financial aspects, I have just put these things into your notes, and you can read through these things and get a good idea about it. And it is possible for you to develop or include more ratios into the financial aspects part of the rating model, and either if you want to remove some of the ratios from that and add some other ratios, so that also can be done by looking at this ratio analysis, and you can get a good idea about it. Solvency ratios and all these are very important. Now you can just look at this ratio. I think it's a type of a new one, defensive interval ratio. What is that? Cash plus marketable securities plus accounts receivable. So these are the liquid type of things where you can put in an estimated daily cash expenditure. So if you get a higher amount here than the estimated daily cash expenditure, so you are very defensive, or you have a defense. In addition to the cash, you have marketable securities. The marketable in the sense you can, without any difficulty, you can market it. You can sell it and realize some money. And accounts receivable also. Now there can be very short-term receivables. There you will receive another 2-3 days time. So that is what you mean by that. So this is just looking at the liquidity, you can do that. And even there's another way of doing it: cash and bank, marketable securities divided by current liabilities. But here, this is only the cash type of things, not the current liabilities. Daily cash expenditure is taken into consideration here. So all those things, actually, I'm not going to elaborate on these things, but I think you can understand yourself. So you can do a self-study on these things. Because you can be thorough with these things, then it is very much easy for you to do a financial analysis in your scorecard. Now I will just look at these things because these things are important in loan evaluations or credit evaluations. Right. We will talk on leverage, operating financial leverage. Now there's a question at the beginning. Will doubling of sales always result in doubling of net profit? How can a business achieve disproportionate increase in net profit versus sales growth? Now, this is the type of a question any businessman can ask. If you can study the leverage ratios, you would be in a position to give an answer for this question. The question is, if you can double your sales, are you in a position to double your net profit? That is what the question is. So that's a good question. But I think, in my opinion, what is your understanding on this? What do you think about it? What do you think about it? Yes. What do you think about it? Yes. Yes, you can put your ideas there. Now the question is, by doubling the sales, are you in a position to double your net profit? But can you give an answer for that? Yeah, you can give a yes or no answer and then give some conditions or give some reasons also. What should be your answer? Right, we will see. We will see. Now, to give an answer for this question, you have to study leverage ratios. Now, when you say leverage ratios, there are two different ratios, and we call them operating leverage and financial leverage. One is the operating leverage, the other one is the financial leverage. Both are leverages, but two leverages are different on its own. When you say operating leverage, it is the sales minus variable cost. Because when the sales increases, variable cost also will increase, but not the fixed cost. Sales minus variable cost divided by operating profit would give you the operating leverage. Then now just read it. Operating leverage measures the impact of the cost structure on operating profit. Depending upon the nature of the activity undertaken and business policies of a firm, the cost structure will differ from firm to firm. While fixed costs do not vary with sales, variable costs vary with sales. Operating leverage tends to be high for a business with high fixed costs. Now, can you just understand what it is? Now, you can just look at it, the particular ratio, operating leverage, that is sales minus variable cost divided by operating profit. Now, if the company has a high fixed cost, what can you say about the sales minus variable cost? if the fixed cost component is high, while increasing the sales, the variable cost also will increase in a very low phase. That means sales minus variable cost will go up when sales increased. Then it will be higher. Operating leverage would be higher. When the fixed cost is high, we call such organizations with operating leverage, high operating leverage. Fixed cost is high. But I am just asking you a question. When you have high fixed cost, increase in sales will really enhance the profits, because fixed costs already been incurred. But variable cost actually, even though if you increase the sales, variable cost also will increase, but that increase may not be equal to the increase in sales. So therefore, there will be a high difference. Then your profitability will go up. Now you look at this one. Suppose ABC Limited and XYZ Limited are operating in the same industry, with the latter relying more on automation, resulting in higher fixed costs. The cost structures are given below. A fixed cost for ABC Limited it is 3, XYZ Limited it is 50 in millions, right? Fixed costs. Now they have the same amount of assets altogether. Variable cost sales. So 85% ABC, XYZ only 40%. When they have sales 50 million, now you just look at the chart here. Now this is a good exercise where you can gather some valuable information. Just look at this. Sales. Now you can put the scenarios for ABC and XYZ. Now you have 50 million sales, that is the low sales, then medium, high. And variable cost would be, now it is given as 42%, 40% for this and 85% for ABC. When it is 50, it is 42.5. So the contribution would be 50 minus 42.5. Fixed cost is 3. The operating profit is 4. Now you know what is operating profit. Operating profit is the contribution minus fixed cost. Contribution minus fixed cost. That is operating profit. What is the contribution? Sales minus variable cost would be the contribution. So you can see when they have a sale of 100 million, their variable cost would be 85 and contribution is 15. Fixed cost is the same, that is then they would have 12. Now when you have 100 sales, that is the double the sales, they will they will have three times of their profits. I mean, their profits being tripled. When it is 150, it is 90. So that means now when they have low fixed cost, now you can see the operating leverage. Now, if you look at the operating leverage of ABC, what is that? Sales minus variable cost is 50 minus 421, 7.5. 7.5 divided by 4. That is the operating leverage. But I don't know whether you can just get some idea about this through this calculation, because this is a this is some complicated type of analysis, and this analysis is a very valid one, because you can just get some hidden type of weaknesses of some companies by going through this type of analysis. This is what you call the operating leverage. Operating leverage is calculated by uh, dividing the contribution with operating profit. When an organization has a high operating leverage, they will be benefiting with high sales, and their profits will go up in a boom time. So that is what you can gather from this. Now you can see operating leverage for these companies been given. Right. Now is it okay now? Is it okay? All of you? We have been discussing about the operating leverage and the financial leverage. So the implications of operating leverage and financial leverage of on a company. So are you in the Yes. Are you with me? Yes, Lakshan? Udena? Can you hear me? Can you hear me?
Yes, sir.
Right. Right. Anyway, now we will have a break now and then we'll start by 10:50. Right. Can you see the text on the screen? Can you see the text on the screen? Yes.
Yes, sir.
Right. 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 Anyway, now we can continue our discussion. We have been discussing about the leverage, and we can divide it into two categories. The one is the operating leverage, the other one is the financial leverage. Now, I will show you on the board what all these things mean. Now, operating leverage is the division of contribution by operating profit. That is the sales minus variable cost divided by operating profit. And the financial leverage is the operating profit divided by net profit. So when you take that into consideration, you need to see how the operating profit is calculated. That is, you have sales minus variable cost is the contribution. Contribution minus fixed cost is the operating profit. So that is how the operating profit is calculated. So I have just explained these things earlier in the earlier session. Now, since I think that this is a more critical thing for a credit analyst, that is why I'm just looking at these things again, because you need to incorporate these things into the rating scorecard under the financial aspects. Now just look at the calculation of operating profit. Here you have sales, then less variable cost, then you have the contribution less fixed cost, you will give you the operating profit. So the net profit would be operating profit deducted some deduction from operating profit. Those are the interest and other costs like that. Those costs can be deducted from that. So anyway, so operating profit is a factor where net profit is another factor. Now I will show you the relationship here. Then we need to go to the total leverage. Now total leverage is actually the multiplication of operating leverage into financial leverage. Now you can just look at this text. Total leverage is calculated by multiplying operating leverage and financial leverage. It examines the combined impact of fixed cost and fixed interest burden on the business. In other words, the determinants of total leverage are the level of fixed cost and the interest burden. During boom times, the high total leverage sharply increases profitability. However, during tough times, high total leverage results in a sharp drop in profitability. Higher total leverage can be considered as a risky proposition since it brings severe volatility to the earnings of the business. That is, while other things remain the same, the presence of high fixed cost and high interest burden create high volatility to the bottom line. Okay, now I will just explain it on the board. I think that would be more beneficial for you. What I thought is that. So with that, you can get a certain picture or mental picture on those things, and that would help you to do an analysis of a particular counterparty with regard to this. Right, I will do the explanation. So first we talk about the financial leverage, that is sales minus VC, that is variable cost divided by operating profit. Then you have another leverage called operating leverage. Sorry, this is operating leverage, financial. Sorry, I made a mistake here. This is operating leverage. This is operating leverage. Then you have financial leverage. That is operating profit divided by net profit. Now, when you look at this, how would the financial leverage go up? How would the financial leverage go up? If you have a operating profit which is very much greater than net profit, then you would expect a higher financial leverage. You got my point? When you have a very high operating profit, when you compare it with the net profit, say for example, you have a net profit of 5 million, whereas your operating profit is 20 million. What does that mean? You have a very high operating profit than the net profit. Then 20 divided by 5 would be 4. 4 is a very high leverage. So then we call it the burden. It's a burden for the company. Because whatever you earn, you have to just give away because of that. So that is a high financial leverage. High financial leverage. Now, if you take the total leverage into consideration, what could happen? Then we will see what is total leverage. So I will just put the equation for the total leverage. Total leverage equals to operating leverage into financial leverage. total leverage is operating leverage into financial leverage. So then what is operating leverage? Sales minus VC divided by operating profit into operating profit divided by net profit. Now you can see same value is there in the, here it is in the denominator, here it is in the numerator. So these two things can be cancelled. You can cancel it. Then what is the value? Sales minus VC, that is variable cost, divided by net profit. This is what you call the leverage. This is what you call the leverage. Now, why I have gone through these things and gave you a certain type of explanation of this nature? Because you should understand the value of that. If you want to check a particular company's leverage, what can we gather from that? If the leverage, the total leverage is high, that means the particular company or the certain organization, their contribution is very much higher than the net profit. Very much higher than the net profit. What does that mean? Now, when they have the variable cost and variable cost sales minus variable cost gives the contribution. Contribution is very much higher when you compare it with net profit. So that means the company has a burden of fixed cost, including the interest cost and so on, financial cost. And that is what you call the burden. When a company has a high financial high leverage, total leverage, what do you get? What is the meaning you get from that? That is, the company has a high burden. High burden. But in an economic downturn scenario, this type of a company would have a bad time. They would lose in the profitability. They will have an adverse effects. But if they just faced with the boom time, invariably they can enhance the profitability in the midst of that burden. That is the indication you should get, and that can become an inside analysis of the firm. Now, if you take the two leverage figures into consideration separately, now the first one is the operating leverage, that is the variable cost, sales minus variable cost divided by operating profit. That is what you call the operating leverage. So when you have a high operating leverage, that means you might have a high fixed cost. Then you have a financial leverage. Now, financial leverage is signified by operating profit divided by net profit. There also you can get an idea. What is the burden type? So then these ratios are very critical for an organization. And I suggest if you can put these ratios into this financial analysis in the rating model, and you can give either a similar type of a weight or higher weight for this, because this gives an idea about the cost structure of the counterparty. The cost structure will have a greater implications in future endeavors. Okay, now I think you got my point, and I will further explain that. Now this particular subject area is very much important on account of financial analysis. That is why I have taken so much of interest on this. Any questions on that? Any questions on that? Because what you need to do is you need to ask questions, you need to clarify. Sometimes you may not understand what I say, then you should ask questions from me. Or even if you want to just refer any type of other text or whatever, then you should ask me. Of course, I have taken these texts from very popular books. One extract I took from Risk Professional's Survival Guide, and there's another one I took from another text, that is Advanced Credit Risk Analysis. Those books are famous books in the international community, and it was recommended by the Global Association of Risk Professionals. Even the chartered financial analyst programs also, they just recommended those books for their members. Yes. And this is a good opportunity for you to go through these things, and very, very valuable type of thing, because it's too expensive. The books are too expensive, but you get a chance to get an idea, go through this text, and you get the explanations also, and that really help you to gather all these things. And you should get the fundamentals graphs, then you can develop your own thinking, you can develop your own ways of doing things. At the beginning of the session, I just explained you how would you do that. Now, as it is for our rating scoring model, we have taken obliger rating model on one side, the other side you have the facility rating model, and on the obliger rating model you have different aspects: business and market aspect, management aspect, financial aspect, cash flow at risk aspect, and all those aspects were there. And for each aspect you have different parameters, and those parameters were given different weights. Now, what you should do is you should go through those things and just check whether these aspects are covering the situations or representing the situations faced by the counterparties. If you feel that those aspects would not cover the situations faced by the counterparties which you refer to. You should add more aspects into that, or you can change the aspects if you feel to do that. At the same time, you should go through the parameters under these different aspects and the weights given to those parameters. First of all, you need to select whether these parameters are suitable or suiting for that. And those parameters the most critical parameters to be checked. If you feel that those are not critical as such, then what you should do is you should take new parameters into consideration and remove the parameters which have already been taken in. That is what you need to do. Now, in the meantime, I wanted you to go through these financial risk aspects in order to think over the financial aspects, the ratio analysis and all. And if you feel that the ratios which have already taken in to the rating model, whether those ratings are whether those ratings are suitable enough to have a financial analysis for your set of counterparties, or you have to add some ratios or remove some ratios. That way also you need to check. And at the same time, you need to check whether the weights are okay. In order to do that, you need to have a thorough knowledge of these financial analysis, a thorough knowledge. That is very much necessary. That's what I just talk on these leverage aspects. And the leverage aspects are very much important in order to check the future behavior of the company or future behavior of the counterparty. That is very much necessary to check the credit risk of the organization or the counterparty. Just looking at the historical things would not help you to get that idea, because even though the organization been doing well in the past, that won't give you a certificate that they would do well in the future also. There's no certificate given. And the organization has to face several uncertainties in the future. Therefore, it is very much necessary for you to do a futuristic analysis. The futuristic analysis part would depend on these leverages and the cash flow at risk analysis. Those would be the most important. Right. Anything you need to clarify on this? Or just look at these things again. Now you can see total leverage. ABC 2.5. Now their total leverage is high when the sales low. When it is medium, it is 1.4. When it is high, it is 1.24. Now you can see in the company ABC, their total leverage is coming to a lower level when they have high sales. But XYZ company, though they have a very high leverage in the medium sales, they will have a low leverage in the high sales. Now, they can retain their profitabilities with low leverages. Then there's another very good point to note, break-even point. So this is a very good analysis on a futuristic basis, because you can have a formula also to just check how much you need to do sales in order to have a break even. That is no loss, no profit situation. So that is the point. So then you need to see how much sales you need to achieve. So this is a very good futuristic approach for credit analysis. So then you can incorporate that also to your financial analysis. Okay, now then you go to the predictive power of ratios. This is the next very important point I want to note as it is. So I think last time also we did it. I want to give you more details on this. This is what you call the Altman's Z score. Now Z score or the model is given here. You don't need to by heart these things, but in a question paper also you might get the formula. But you won't get the formula with these things sometimes. So therefore you can, anyway, this x1, x2, x3 also will be given. Working capital divided by total assets is the x1. X2 is retained earnings since inception divided by total assets. X3 is profit before interest and tax, that is PBIT divided by total assets. X4 is market value of equity divided by book value of total debt. Then X5 is the sales divided by total assets. Now you can see most of the parameters being introduced with the denominator with total assets. Everywhere you find the denominator as total assets, except X4. All others are with the denominator total assets, right? Now the interpretation is also given here as it is. We call it a bankruptcy model. I think last time also we did it. Right, now there's a case study also given here. Right, in addition to the earlier information, you would get additional information as this, because as a case, I just explained these things. Now here it says the turnover comprises equipment and automotive 296.6 million. Now this is a breakup given, the turnover. Consumer products $714 million. Industrial products 298 million products, and office equipment 171 million billion dollars. And it represents the global brands such as Toshiba, Xerox, Nestle, Bridgestone, Pepsi, and Caterpillar. And largest inventory item was trading inventory and finished goods, which towards 2010 to end decreased to 191 million. And it was 222 million as at 31/12/2009. Shareholders had purchased loan outstanding government receivables amounting to $49 million of a group company to improve its cash flows Unused bank facilities as at 31/12/2010 were 168 million. Sales growth of 2010 is almost in line with the previous years. Trade in inventory and finished goods as at 31/12/2010 was 191 million. Now these things are given as additional information. You may calculate the financial ratios and prepare a brief analytical report deriving the financial risk involved. Structure your report covering performance, profitability, working capital management, liquidity and cash flows. So the ratios been calculated here. Now the analysis is done here. Finance analysis report, profitability, all been done. Right. Now with that, I think you can just think about the Saltman's Z score as it is. I just told you that there's a way of getting the probability of default after calculating the Z score, and then you can just do the just apply it into the logic model and get the probability of default also calculated. Then if you can check certain metrics, migration metrics prepared by an external rating agency, then you can see the probability of default pertaining to each rating grades. And after calculating the probability of default of the company, you would be in a position to map it to the external rating agency's grading. For example, through the Z score calculation, you would be in a position to arrive at the probability of default of the counterparty. Say it comes as 0.05%. 0.05%. Say that would be the probability of default as per our Z score. So then you need to check published migration metrics published by a external rating agency, say Fitch Ratings. So then you can see in which rating grade or to which rating grade we can map that 0.05% probability of default. If the mapping goes to A rating, then you can say the counterparty's credit rating is A as per Fitch Ratings. But this is an approximate type of a rating, because even though the probability of default tallies with that rating grade, it doesn't mean that the other criteria are being met by the counterparty. So therefore, you have only a very draft, or we can say very approximate and very draft type of a or very indicative type of a rating there. Of course, now what you can do as an exercise is you can get financial statements from some organizations Say, for example, if you go into the Colombo Stock Exchange, you can get the financial statements of or financial final accounts of certain companies. Then what you can do is, or in these annual reports, you might get past 5 years data, and you can calculate the ratios for the past 5 years and get the averages, and you can apply the Altman-Cisco model for that, and applying the Altman's Z score, you would be in a position to arrive at the probability of default of that organization. So that is one way to check these things, what we have learned. And I think I just gave you the formula in order to arrive at probability of default by applying the certain set score which you have calculated. I think that last day also, last time also we did that. But today I think we can have a more comprehensive type of thing. But in this text, you don't find that formula. The formula of getting the probability of default. Now I just want you to focus your attention here. Altman's Z score. Right. Now X1 refers to working capital to total assets. X2 refers to retained earnings to total assets. X3 refers to profit before interest and tax to total assets. Then the market value of equity to book value of debt. And sales to total assets is the X5. So with that, the values are given here and those values being applied here, and their Z score is taken as 3.06. And as per our determinant, if the Z score is above 2.8, the risk of bankruptcy is low for this company, so the default risk is low. So what we can do is, now we can just see, I think last time also I just asked you to do that. Say for example, if the Z score comes as 4, have we done that? With the Z score 4, have we done the probability of default for that? What do you say? Last time I can't remember, because have we done that? We did something, no? Having Z score calculated, afterwards we just apply that Z score to the logit model and arrive at the probability of default. Or shall we do another one today? Right. Anyway, so just assume that you calculated the Z score for a certain organization, right? And you arrive at the Z score, and then that Z score being substituted in the formula, logit formula, and then you arrive at probability of default. Right. Now, for the time being, I will just give you a small exercise where you can apply the Z score and get the probability of default calculated. So then I just suggest to get this our NCD. Now we just took NCD as our case study, to do the rating model. So if you go through the financials of that, you would be in a position to arrive at X1, X2, X3, X4, and X5. In that manner, you would be in a position to get the Z score of that NCD. Shall we do that? Shall we do that? I think that helps you to enhance your understanding on that. You did the scoring also, and then you can see when you do a Z score analysis and arrive at the PD, that PD is tallying with the PD which you got through your rating score or the rating migration matrices. So that's a way of doing a validation. You got my point? Anyway, are you comfortable with doing that? Are you comfortable with doing that? Oh, shall we do it? In order to do that, we need to get the financial data and calculate the parameters. The parameters are X1 up to X5. So if you do that, you would be in a position to get the Z calculated for NCD. And with that, we would be in a position to calculate the probability of default also. Is that clear? Right. And anything else you need to clarify on this? Anything else? Okay. Now I will show you the calculation of probability default when you have the value for Z. The logit PD is equal to 1 over 1 plus e to the power minus Z. Z is the score calculated on Altman's Z score model. So I think you can note it down. You can note it down. So it is worthwhile to note down. And this was a research done by a certain analytical group. And they came out with their results. They found that it gave some positive results with about 85% to 90% accuracy. If anyone feels that these things are not understood or you face any difficulties in understanding these things, let me know. So we need to have a discussion on that. When you calculate the PD, that's a very critical thing in order to have an idea about the expected loss of that counterparty. Not only the PD, the LGD also we need to calculate, and through that it is easy for us to arrive at the expected loss. Now, as I told you earlier, we did our rating models to get obliger rating and facility rating. Now, having these two things separately would not help us. We need to consolidate these two things. How are we going to consolidate these two things? We can get an idea, or we can map the obliger grading into the probability of default. And we can map the facility grading into loss given default. Then if you have, for example, if you have obliger grading as 3 and facility grading as 4, what we should do is we need to get the range of probability of default in relation to facility grading 3, obliger grading 3. And we need to get the range of LGD or a facility grading 4. Then we need to multiply that. Now, after the multiplication, we get expected loss indication. So that indication we need to check which grading you can put. That is the consolidated grading for your counterparty. Is that okay? If you have any confusion on that, let me know. Any confusion?
So can you please repeat it again?
Yeah. Now it is like this. Now, when you do the obliger rating, then you get the grading. Say, for example, you get the grading as 3 as per the score received. So when you get the grading 3, that grading can be mapped into a certain probability of default. Either a probability of default or a range of defaults. You need to determine that range. Then you need to go to the facility rating also for the same counterpart. The facility rating, say it comes as 4. Then you can get the chart for LGDs for facility ratings. So you have to get the facility ratings relevant LGD of the loss given default. Then how are we going to then consolidate this? You need to get the respective EDA for the probability of default. You got through the obliger rating and multiply it with the LGD you got through the facility rating. The result is the expected loss. And there's another scale where you have prepared expected losses with different ratings. Then you can choose the rating which is telling with your score of expected loss. That would be the consolidated rating for your counterpart. Is that clear?
Yes, sir. Now it's clear.
Right. So then I just put this formula. I think you need to take it down, the formula. And if you feel that it is necessary to do another exercise on this, we will do it. Because are you familiar with the mathematics of this? Or the way of calculation? Using your calculators? Definitely, if you have a scientific calculator, it is possible. No issue, and it's a very simple target or simple task to it. And make sure that you get the 1 minus thing here, because we just don't get the PD here. We just get the logic PD. So logic PD means the answer you have to deduct from 1 to get the real PD. I think now we have just gone through different aspects of facilities or different aspects of counterparties. And you remember we did a completely analytical method to arrive at probability of default of some counterparties. And we call such probabilities of default as risk neutral. What is the reason for that? The reason was we have just gone through their asset ownership or mortgage assets or whatever, and not taken into consideration their own things, other things. Because we just got some ideas about external things only. For example, we got an idea about the assets which have been mortgaged, the value of assets. And we got an idea about the loan to value ratio. Then we got an idea about the volatility of the property prices, of the asset prices, and the risk-free rate in the market. So those are the things which we have taken into consideration, but we have not taken anything into consideration with regard to the risk. That is why we call such analytical probabilities of default as risk neutral. Now, why we have such parametric methods to arrive at probability of default rather than the credit rating models or historical methods? Because in order to do credit rating model also, you need to have some infrastructure. Whereas if you do the Merton model and then calculate the probability of default, there you don't need this infrastructure. It is only a matter of getting the asset prices and its volatilities. I think that might be available on normal general websites or in general type of information databases. In some countries, the central bank provides the real estate or the property value, property prices, volatilities also. Not only that, there can be several other data or information provided by the central bank through a general database. With the help of such databases, these analytical methods could be used. And there you don't need a chain of historical data.
chain of infrastructure, whatever. Now, say for example, if you do not have a rating model in your organization, you are not in a position to arrive at EDF or the probability of default through the rating model. Sometimes you might have a rating model, but you don't have historical data for 5-6 years. You have just started that rating model. There also you can't do that. Those are the limitations. Those are the limitations. So you have to think over those limitations. And when you have such limitations, you can just go back to Robert Merton's default model. Of course, that is also possible for mortgage type of advances, not the others. So that is how these things are being arranged. And at this juncture, if you have any other questions, you can just raise. Otherwise, I will go into the next parametric or probability, portfolio-wise certain type of calculations. Because this is an important or critical form of analysis. And it's not an academic exercise, it's a type of a practical thing. And what is the purpose of these things? The purpose is to analyze and identify the creditworthiness of your counterparties. In that way, you would be in a position to get an idea about the asset quality, the quality of your portfolio. If you feel that the quality of the portfolio is not as required by your organization, then you need to do something on that in order to enhance the quality of the portfolio. So you need to get rid of some of the advances in that case. And you need to go for better advances portfolio. But that is not a task which you can do within a short period of time. You need to have a project for that. You need to have some projections, and then in 2-3 years, you would be in a position to enhance the quality of your portfolio with some active management portfolios. It's a challenging task. But if you have the necessary knowledge, the necessary skills, necessary experience on those things, you can guide your teams to achieve such type of enhanced quality portfolio. It will enhance the profitability of the organization, and your income would go up. And you will have a better margin, in NIM, better net interest margin. If your non-performing advances are going up, it could retard the net interest income. By retarding the net interest income, your margins will be getting thinner. And that could really turn your organization into an unprofitable one. And you might have some capital issues also. Because of that, this management or the credit risk management would be very much important for a bank or a non-bank financial organization. Anything you need to clarify on this?
So can you please repeat the meaning you have,
Repeat
the
what?
thing you have mentioned in your whiteboard? It's not clear. You said is the
Is that so?
behind you.
So, right, I will just write it on bigger letters, right? Is that okay? If you write it
Okay.
on bigger letters, is that okay now? Can you zoom it and see?
No, sir. Even though Zoom, it's not clear.
Okay, okay. I will write on big letters. Is it okay now? Is it okay?
So can you please repeat it, sir? Z is the, then I can write it because
Yes,
I don't
logit
know. The
PD.
problem is mind
Yeah,
level.
yeah, okay. Logit PD. Yeah, logit PD, that is the left hand side. Logit PD is equal to 1 over 1 plus e to the power minus z. 1 over 1 plus e to the power minus z. Then I have written down z is the value obtained
That part I
from
need, sir. Z is the.
Altman's. Yeah, yeah. Z is the value obtained from Altman's Z score model. Altman's Z score model. Is that clear? Yes, Felicia, have you taken down? Yes.
Yes, sir. Now it's clear. Thank you, sir.
Right. Right. Now we can just see how we can go into a certain analytical form with regard to a counterparty. Right. I can just give you a certain exercise here. So try to do that and arrive at the probability of default. So I think what I feel is the case what we have gone through, that is NCD, and as per that, you had a probability of default or the facility grading. I can remember we had the facility grading for them as 4 in the first year and 5 in the second year. And the 4 relates to a external grading system triple B. So I imagine a certain Z score for that, and just what you need to do is you need to calculate the probability of default in relation to that Z score. Right? Or I will give you different Z values. You have to arrive at the relevant probabilities of default for those Z values. So I will just give you the Z values, and your task is to calculate the probability of default for those Z values. Right? I will just put it on the board. Right. Now what you need to do is, I have given you 5 Z values, 1, 2, 3, 4, 5. And what you need to do is, you need to get the PD calculated for each Z value with the help of the logic model. Right, do it. So then you will see when the Z value is 1, what would be the PD? When the Z value is 2, what would be the PD? When the Z value is 3, what would be the PD? When the Z value is 4, what would be the PD? When the Z value is 5, what would be the PD? So those things you need to do. Just do it now. Take the calculator to your hands and do it. I just request all of you to engage with me and do the exercise while the lecture is on. That is the best way to learn. Don't rely on these recordings and all, because it is little difficult for you to do that. So therefore, I just advise you to engage with me when the lecture is on. Then interactively you can involve. That involvement would give you a better chance or better understanding.
Right. So if you get even one result, you can come up with that result. Yes. Yes, I need your answers. Resha, Felicia, no? Then Felicia, I think you got the formula also, no? So you just do the calculation and get the answer. First of all, you calculate the PD for Z value 1, and the Z value is 1, what is the PD? Yes. I think Udena also can see, Anjali, Charit. I'm just looking for one answer, not the whole thing. You just come up with one answer when Z is 1 also. Uresha, can you get an answer? Very good. Sumudhu has given an answer. Yes, that is correct. He has given the answer for when Z is 1. He has given the correct answer. Yes. So you try for the answer when Z is 2.
Sir, last week also I was not a bit clear on this. So we have to
Yeah.
get this Z value from the Coleman's probability.
Altman's Z score. Yeah.
1. So that means we have to get the respective value against the 2.
Yeah. It's like this. Now say, for example, Z value is given with a certain model, no?
Yes.
1.2 x1 plus 1.3 x2 or something like that, no? So that model, there you have defined the x1, x2 up to x5. So
can you show that sheet?
Yeah, actually, today also I just showed you that.
Yeah, previously you showed. So when we are doing this calculation.
Yeah. Wait, I will do that. Now you can just look at it. Now this is the one. is the formula, right?
Yes.
Can you see that? Right. So in this formula, the Z is calculated. Z is 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 0.1 x5. Now this is what you call the Altman's Z-score formula.
Correct.
Right. Now then you might wonder what these x1, x2 and so forth are. Now this is x1, working capital divided by total assets. That is x1, right? Retained earnings divided by total asset, that is x2. So likewise, these x1, x2, x3, x4 and x5 parameters are defined. I think this is clear, no? These parameters are defined.
Yes, sir.
So, those parameters can be determined by looking at the financial statement of the counterparty. Through the financial statements, you do these calculations, right? Now, if you have the financial statements, you are in a position to calculate those parameters. Yeah. Now, for example, now say, what is the first parameter? That is working capital divided by total assets, right?
Yes.
Working capital divided by total assets. So then when you just get a certain financial statement, there you can calculate the working capital.
Yes, sir. So it's basically it's the weight into kind of the ratio which we are getting
That
from the
is it.
financial
Yeah,
institution.
yeah. So this is given another name also. So I think you can note it down. That is also worth to note down. So we call it linear discriminant analysis. Linear discriminant analysis, right? So this Altman's Z-score model is a type of a linear discriminant analysis. So all these parameters are being multiplied with certain coefficients or certain constants. So these coefficients are given as 1.2, 1.4, 3.3, 0.6 and 0.1. So then the Z-score is calculated on that basis. So you have already taken the values of x1, x2, x3, x4 and x5. So in this text, a particular example is given. Right. They have given these values. The following ratios are computed for Lame Duck Limited for the financial year 2022 or say. Then in that organization, as per their financial statements, working capital divided by total assets is 28%. That is x1, right? In that organization, you just went through the financial statements and found that retained earnings divided by total assets come to 30%. That is called x2. And for that organization, the Lame Duck Limited, their profit before interest and tax divided by total assets is 33%. That is x3. Then you have market value of equity to book value of debt. That is market value of equity can be taken from the financial statements. It is to be divided with book value of debt. That comes to 160%. That is x4. Sales to total assets, that comes to 250%. That comes to that is x5. So now it has already been calculated. x1, x2, x3, x4 and x5. Now what you need to do is you need to substitute these values into the Z-score model. So that is explained here. So you just look at it.
That's clear.
So then these things being applied. So x1 is 28%, so that 1.2 into 28%. x2 is 30%, 1.4 into 30%. And then again, I think there's a mistake here. So you just take it as plus, and then the next one would be x3, no, 3.3 into 33% plus 0.6 into 160% plus 0.1 into 250%. So that comes to 3.06. So that is how the Z score is calculated. Now in my exercise, I have given the Z score. You didn't have to bother to calculate Z. I have already given Z. So with the Z is with the calculated Z, you would be in a position to get the probability of result with my formula. I have given that formula to you know. So that is how the PD calculation to be made with the help of that formula. So I think I just gave that formula to you. That is logit PD is equal to 1 over 1 plus e to the power minus Z. Now is that okay? Yes, Uresha?
So into the power minus Z, so that means we have to get that part is, can you just explain that?
Right, okay, right. And now up to Z calculation,
Yes,
you have to,
this
no?
part is clear, yes, sir.
Right, okay, right. So then we need to go to the that formula part. So I will go to that formula part again. Yes. Just look at the formula part. Now I will erase these things and then I will go into the formula. Now, on the top, I write the formula. Logit PD is equal to 1 over 1 plus e to the power minus Z. Is that clear? Now, e to the power minus is very clear. Okay, right. Now, say when Z is 1, so that is the exercise what I have given to you. When Z is equal to 1, so I can just apply or I can substitute the value Z here. So that is equal to 1 over 1 plus e to the power minus 1. In the place of Z, I just substituted the value of 1. So I will do the calculation now. I can just get my calculator. So then what I will do is I calculate e to the power minus 1, right? So I get the value 0.36787. Point 36787 as the value for e to the power minus 1. So then it is now the value now comes to 1 over 1.36787. So with the calculator, I would be able to calculate this also. So then I will see that. So that comes to 0.7310. That comes to 0.7310. 0.7310. But that is logit PD. That is logit PD. But we don't need logit PD. We need PD. So then PD is equal to 1 minus 0.7310. So we will get it as what is that? So that is 0.2690. 0.2690 As a percentage, it is 26.9. This is how the PD is calculated when the Z value is 1. Is that okay?
Yes, sir. Thank you.
Right. So when you, if you want to get the PD when the Z value is 2, yeah, what you have to do is you need to apply 2 here rather than 1. Then you get e to the power minus 2. Then you get the calculation and come up with logit PD, and 1 minus logit PD would be the PD. Anyone who calculated when Z is 2, I think one person has calculated the value when Z is 1, that is 26.90 or 89. So what is the, yes, Samudh has calculated that. So others, can you try to calculate that? This is not a difficult task. I have clearly explained the things. I think you have to, you need to have your own attempts or own interest to get what I have said. Yes, can you just get the value for when the Z is 2, what should be the value? When Z is 2, what should be the value? Yes, Sumudhu, have you done it? Thavodini, have you checked that, or have you tried the calculation? Yes, 11.92 is the second one. Yes, when Z is 2, it would be 11.92. Uresha, have you calculated that when it is 1, Z is 1? Yes, Thavodini, what is the question? Yes. Yes, anything you need to clarify? Yes, Thavodini, what is the issue? Just tell me. You can unmute and tell me. Yes, what is the question?
No, sir. It is, and I think mistakenly I have pressed it.
Right.
Sorry, sir. Sorry.
Okay. Then, Uresha, have you?
Yes, sir. 11.92. Okay. Sir.
Okay. Right now, I think you should get the other values also. And what I want to do is, want you to do is, just see how these values are becoming lower and lower when the Z value goes up. How you can just see when the Z value is 1, the PD is 26.89. That's rather a big value or big PD, or it's a highly dangerous or highly risky type of a credit. When Z is 2, it is 11.92. That is less than the earlier PD, but that is also substantial PD. But when the Z is 3, you can see it has drastically come down to 4.7. Right? When you do the calculation, you would find it. And so next one, that is when Z is 4, it has come down to 1.79%. That's a very, very small probability of default, and that means when the Z value is 4, you can really say that that is double A or so in a rating scale of external rating agency. So when you have 5, it is very much low, and the probability of default becomes very close to 0. It's 0.66 like. So that is how it happens. So which would tell you that when the Z value is going up and up, the creditworthiness of a borrower would be very much higher. So that's a very important type of a formula we can use even in your organizations. If you are engaged in credit analysis, you would really appreciate these methodologies, because you are in a position to apply these things into their financial statements and get the search score and get an idea about their probability of default. So that's a very important point to know. Right. Anyway, I think with that, we should know how we can really go forward with this. Anyway, any questions you have? Any clarifications? What I want to stress is you all should engage with the calculations, with the explanations, arguments, comments, or whatever. You all should lively engage. If you don't do that, it is very difficult for you to gather these things. Now, I think if you lively engage these things, you would find how easy you can grasp these things. Though you thought it as so complex, but when you just begin to understand these things, you would find how easy these things are. Though you thought about it as very complex. So the best thing is to be with the lecture, actively participating in the lecture, and very interactively you need to participate. That will give you the highest benefit. Now, what I feel is some of the candidates or some of the participants, they just passively participate in the lecture, and later they need to play back the recording. I think you should not go into that practice. That's a type of a secondary importance, because you will really not get the best out of it. But in an unavoidable circumstances, sometimes you would not be in a position to participate in the lecture lively. Then only you need to go into that. Otherwise, you don't put it as a practice. You should not put it as a practice. So that will really put you into trouble. So I just request all of you not to do that, because that's why people need to have these recordings in the mid of the week or whatever. So I just don't feel that as really conducive for you. It's only a matter of mitigation. So if you can't, with an unavoidable circumstance, if you can't engage with the lecture, then it's okay. Otherwise, don't take it as a practice. Don't take it as a practice. I think that will just put you into more trouble. Right. Anyway, with that, I think anything else you need to clarify?
So last week you told that the assignment will be shared, but we didn't see it.
Sorry. Sorry for that, but anyway, the thing is, what I felt was, since we have to just go through some other sections also on operational risk, we have not done it up to now. So therefore, I think even though I told that, because there's no necessity to just give it so hastily. But anyway, if you want to have it now in a formal way, I will give it during the next week. I will put it anyway. But we need to go through the operation risk also. Right, I will give it then, of course, since I just told you to do that. Anyway, I will give that. I will give that, and you can expect it in the mid of the week. And that is, I have already told you what I would give you. Anyway, I will put it in a formal way and give it. So it is nothing other than having a rating model established in your organization, and you have to just give the different aspects you are going to take into consideration and different parameters in those aspects. And the way you do the scoring and all that has to be given in detail. And that is, then next thing is you have to have a particular case or whatever, and that case also to be applied into that rating model and give the result. So that is what you need to do. Anyway, I will put it in formal paper and just give it to you. But still, you have the things already, so you can start your work if you want.
Okay, sir.
Right?
Thank you.
Right.